Awesome. Thank you very much to everybody for joining us today. We'll have more people joining as we go along. I hope you're all staying well and safe, and I'm super excited today to have Patrick joining us. As well as being a friend, he's an extremely successful lawyer in a previous life at many legal firms, but recently through Support Legal, focused on startups, and only recently started a company himself through Clara Technology. And really, I thought it was useful to have someone like Patrick join us today for a number of reasons, but most importantly, to kind of try and understand the behavior that we need to be aware of as founders who are currently fundraising when having that fundraising exercise with investors. In fact, I pitched this idea to Patrick a couple of months ago during the good times, and it was to try and reinforce the webinar we did with Dunya to say, that was kind of legal terms 101. What's the next level that you should really be aware of as we're seeing a heat up in the startup ecosystem here in the region? Well, the truth of the matter is that the landscape's completely changed now with COVID-19. There's a decrease in the amount of capital that's there. In fact, the poll that we did last time when Walid joined us saw that 80% of people on the poll, on the webinar, highlighted that valuations are going to go and move in favor of investors. And I think the truth of the matter is that there is likely to be discounts in valuations and a very different rhetoric when you're speaking with investors. The title is Avoiding Harmful Investment Terms When Fundraising During COVID-19. And really, before I jump into it with Patrick, I really want to try and get out a deep dive into terms that we need to be aware of and bad behavior that you need to be aware of as founders. Because ultimately, and I'll let Patrick articulate this better than I, what you may do in the short term to get cash may lead to long-term issues for you in the future. So firstly, I'd like to welcome Patrick, and thank you very much for joining us today.
Thank you, Philip.
Now, I'm going to put my own caveat. He's the lawyer, but let's be clear. Each fundraise needs to be assessed on its own merits. And the first thing I think both of us will say is seek legal guidance. Whatever is kind of highlighted today is kind of a high level opinion or view, but for each of you individually that may be raising funds, go and seek legal guidance as you go along. And I guess you would agree with that, Patrick.
Each situation has its own set of particular circumstances, and I don't think your lawyers should be charging you for the generic paperwork that we all have as the starting points. It's how we align your fact pattern with the views of your investors and where you want to take the business. I guess that's where the magic is. And I do think the right lawyers can be very helpful in that respect.
Awesome. Before we dig into kind of some of the more complicated details of term sheets and terms, I mean, what's your current view of the ecosystem? You're seeing that through Clara, you're seeing that through Support Legal, you're probably seeing a lot of founders and investors from both sides in terms of conversations. Has there been a change of behavior, and have you seen a pattern of bad investor behavior in the ecosystem?
Before I get to that, I think there's an important point I want to touch on. I don't know if you guys had planned this out, but I saw that your previous webinar this week was with my friend Hassam Arab, who also, like me, happens to be rather follically challenged. And I was kind of hoping that that was going to lead to a big unveil today, that you might show up on this webinar, Philip, with a shaved dome, but I see that's not the case. So maybe you can be a bit more brave next week.
Yeah, we'll see. Maybe we'll do a poll as part of the webinar, and maybe we can put some money to charity towards that. But it's dedefinitely getting harder to maintain.
Okay, so back to business. So what am I seeing in the market? What their team seeing in the market? Is that the question?
Yeah, basically, I mean, have you seen a change in behavior, and have you seen a pattern of bad behavior?
I wouldn't call it a pattern yet. I mean, I think you just referenced kind of a point in time when we had our last discussion about this seminar. That was the first day of March, and how rapidly things have changed since then. Since then, we've seen a couple of data points of people, saying they're going to be the lead investor, signing the term sheet, and pulling out, which is bad behavior and disappointing, obviously. We've seen some elements of people trying to insert provisions into term sheets that you do not see in normal circumstances under market norms. I would not call that a pattern yet, but again, this is early days. Going through the summer, I think you will start to see provisions in term sheets that you have not seen for a while.
So, I mean, let's put it like this. If you're an investor right now who's looking to be opportunistic, obviously cash is king. So startups that are bootstrapped or strapped for cash. And again, I guess a good question is, as a lawyer more than anything else, at what point do you need to fundraise? What's a burn rate that's an alarm that you need to fundraise for?
Oh, so if you're saying if we're on as legal counsel to a company and we're
Yeah.
seeing what their burn is or what runway they have left.
Yes.
I mean, if you need to raise before we get to the fourth quarter, you need
Start doing
to
it
raise,
now.
and
Now.
you need to be hustling hard, and you need to quickly realize that you are in a very different dynamic than where we were in February. Things have shifted, and I think you've had some previous guests on who have discussed this, but people have to remember that there's not a lot of people out there with dry powder to go and spend on new investments. The majority of VCs are focusing their energies on their existing portfolio. You know, I think a rule of thumb is typically it was the 20-80 rule. So in the good times, 20% of their time is focused on the portfolio, 80% is spent at looking at new investments. That is inverted, if not more so in the current environment, because the VCs are essentially having to do the exercise of saying, okay, who is going to be alive on January 1st? Who do we think will be alive? And just saying, okay, well, we've got to separate the wheat from the chaff here and follow on or do inside rounds with our existing portfolio companies who we think have a ton of promise, but just as a result of this black swan event might be carried off with it and might go insolvent. So we need to focus our energies on that. And then if there's time left over, we can engage in new investment discussions. But for a lot of the guys who were very keen on looking at new investments 2 months ago, that's not the case right now. They're still trying to figure out which elements of their existing portfolio are going to stay alive.
Okay, so you're an investor and you're saying that you have dry powder and you're looking to invest, but let's say that you're a bad investor for all intents and purposes. What are the kind of terms that you would start looking at to potentially insert or to put, let's call it bad behavior, into a term sheet where a founder may be strapped for cash and will sign anything that a founder should just genuinely be aware of? What would you say are the top 5 terms to be aware of when you're looking at a term sheet?
I'll preface this by saying that I think that's a very short-termist view for any investor that adopts that as a strategy. Yes, they may be getting some quick wins in this environment on that basis and be getting some great terms over on the founders, but it is bad investor behavior. Word gets around, founders talk to each other, and as conditions improve, there'll be a bit of a black mark on that particular investor if they're trying to be very aggressive in this environment. With that said, things that you might look to insert in a term sheet, if that is your worldview, are things like ratchets, which are a form of anti-dilution protection. You know, a kind of broad-based, what we'd call a broad-based weighted average, has become a market norm, but a full ratchet, which would basically say that, you know, if I'm giving you money at a $20 million valuation and you raise your next round, down round at a $10 million valuation, I get all these additional shares, which basically reflect the fact that it was as if I invested at the $10 million valuation. Obviously, that has massive dilutive effects for not only the founders, but other existing investors. So anti-dilution protection in the form of ratchets. Double dipping, what we might call it. People are familiar with the liquidation preference. So most sophisticated investors will insist that they get preferred shares, which is a separate class of shares from common or ordinary shares, which the founders would typically hold. Now, the key element, one of the key elements of getting that class of preferred shares is the liquidation preference that attaches to it. Liquidation preference is kind of a downside protection for investors. If they invest again at a $20 million valuation, and a year later you go to sell the company for $5, they don't want you as the founder making off like a bandit. So what their liquidation preference right gives them is the ability to say, I as the investor get the choice of getting my money back. So I get 1x my investment, that's my preference, or I can choose to convert into ordinary shares alongside the founders and participate pro rata based on the overall percentage of the cap table that I own. So it is very much a downside protection. Now, in a market like this, people are using it as a sword. So they might say, look, I'm going to take a 2 or a 3x liquidation preference. So if there's an exit, first of all, I get 3 times my money back, and then the rest of the cash can be distributed. Going further than that, you would have what we call a participating preferred. It's what double dipping is. So I participate under my preference, so I get paid out my investment sum, my investment contribution, either 1x, 2x, whatever it is. And then, in addition to that, I convert theoretically into common shares or ordinary shares, and also participate alongside the founders. So I get paid out twice.
So that's
double dipping.
That's the double dipping that you're mentioning. So I mean, is that the
Correct.
terminology that you'd see in the term sheet? It's the participation preferred terminology that would be embedded into it.
In the term sheet, in the category of type of security that the investor is getting, it would say preferred shares, right? Like Series A preferred shares, whatever it is, and then it would go on to list the rights that are going to attach to those preferred shares. It would talk about the preference and participation rights or lack thereof.
Okay.
So yeah,
fine.
you would see that very uncommon to for startups to accept a double dip or a participating preferred, and even for that matter, a preference multiple above a 1x.
And for anyone on the call, obviously we're going to have different stages, and if you're talking about a seed stage investment, it's common to have a convertible note, for instance, a KISS note. Are these terms still applicable in those type of notes, or are they tending to arise in Series A standalone term sheets that are drafted through lawyers? Can these fall at all different type of categories of legal structures?
No, these would very much be documented as part of what we would call a priced round. So an investment where the investor is actually getting shares. If you're raising on a SAFE or a convertible loan or a KISS, you're not actually getting shares. You have a right to convert a piece of paper into shares at some point in the future when the next raise occurs.
Okay. Fine.
But
so somebody's just asking
as a corollary to this point, it's actually, the founders on the call should be very mindful if they've raised money on convertibles like a SAFE or a KISS in recent months or in the past year, because founders always assume that those investments will convert at the valuation cap. In other words, they're confident that their Series A raise, their Series B raise will be well above the valuation cap. If it is not, obviously the investors convert at the discount, and that can have hugely dilutive effects on you as the founders in particular. So you would be well advised to go look at the terms of your convertibles, of your notes, see what that looks like, and run a cap table scenario against what you're currently being told by VCs that your company is worth.
Yeah, that's an excellent point for anyone that already has a KISS note that's looking to raise now in terms of that valuation level. So others, you mentioned a few to me before the call. I mean, you mentioned anti-dilution and ratcheting. Just, to dive into that a little bit more, how is that applicable in this case? Is it more specifically in down rounds or also rounds that are higher? Is it only applicable to down rounds?
Rounds that are higher, it's irrelevant. It's when you have a down round that this really kicks in. And depending on the way that the ratchet is structured, the investors that have those ratchet rights will basically be given for free a whole bunch of additional shares, thereby diluting the others on the cap table. So it can have a very big impact, and there's all sorts of different ways that you can structure the ratchet. But a full ratchet is as aggressive a term as you can see in a term sheet. Very uncommon, outside of depression era scenarios or types of environments we're in now. But founders should be very aware of what that means if they see that provision in a term sheet.
Is there a benchmark anti-dilution protection which is acceptable for a startup to accept from an investor?
We don't have a lot of time on this call, but I'd say that what we might call a broad-based weighted average, which gives the investors a protection that's akin to a valuation that is a blend of the last valuation that the investors invested on and the down round valuation.
Okay, makes sense. Other terms, I mean, that you think people should be aware of? You mentioned a few.
Tranching is a big one. So if you think about it this way, if an investor says, "Yeah, I want to lead your Series A, we're going to come in for $4 million and lead the round, but I'm only going to give you $1 million on completion. The remaining $3 million, I am going to give you once you've achieved a KPI list that we will agree."
Yeah,
this is obviously not the norm, because this is a big risk on moment for founders and for startups, because in almost all cases, in order to achieve those KPIs, they need a certain amount of cash in the bank to hire people, to spend on marketing, advertising, development, whatever it may be. So the investor is in essence saying, you know, I'm going to give you a little bit of money, see how you do, and then if you get to the next level, you'll unlock the next tranche, and so on and so on. It's a very delicate dance to proceed through with your investor on that basis. And then, you know, as a founder, obviously, you always have that nightmare scenario where even if you do achieve the KPIs, the investor defaults, and then you're into dispute, which is why we've never recommend accepting something like that.
It's interesting because I was looking into this after we discussed this yesterday a little bit, and one of the things that made me a little bit nervous is part of this, depending on your different stage, means that you may need to start kind of pivot as a company, or develop new products, or see where the market's taking you, and etc. If you're stuck against specific KPIs, it doesn't give you the flexibility to potentially do that. What are the type of KPIs that would be hazards to meet? I guess revenue or traction KPIs, or are they
paid subscribers, revenue numbers? But again, as you just pointed out, Philip, by and large, these are we're talking about very early stage companies here, where in order for the founding team to execute, they need a lot of flexibility. So the lead investor might have a board seat, but the board reserve matters, the matters over which they have a say or can provide input, are and should be quite limited, because you don't know which way your business is going to go when you are super early stage. And particularly in this environment, you might need to make a very hard pivot that has nothing to do with the KPIs that were agreed 6 months previously. So again, there are a variety of reasons why tranching with set KPIs against the payment of those tranches is a dangerous thing.
And just something that came to me while we were speaking, assuming here you see it's common to have multiple investors invest in a round, is it practice to have one investor that offers ratcheting and the others don't, or do you all need to be bound by the same term sheet for that to be applicable?
No, I think, tranching or ratcheting?
Tranching, sorry.
So payment and tranches.
KPIs,
yeah, so payment and tranches, again, so that is a possibility. And you got to remember, if that investor says, I'm going to give you $4 million if you achieve these KPIs, they don't get their $4 million worth of shares on day one.
Yeah.
They will only get the shares that they have actually paid for. Okay. And then they can unlock those future shares with payment against that tranche, if that makes sense. So in theory, the other investors in a round could pay up front and not insist on any type of tranching. Obviously, they get their full allocation of shares on completion, whereas an investor who insists on the tranching might have to wait. They might only get 25% of their full allocation on day one. But you know, the other investors in that round, I mean, you know how this works. Other investors in a round will typically want to coalesce around an agreed set of terms for the term sheet, and I think would very much look down upon an investor who is putting founders in that position while they are ready to play ball on kind of market standard terms.
Board seats. I mean, obviously now is a time for investors to push to have more oversights. What are potential things to be concerned about if an investor's pushing to have too much? I think board seats and oversight is important for any startup, but there can be a little bit too much oversight if it slows down the running of a business. What are some of the things to be concerned about there?
I'd make 3 comments on that. Number one, depending on your stage, are you actually giving up board control? So are you losing balance of power on the board? Or is the balance of power now held by an independent that the VCs have insisted upon including? So as an example, if you've got a 5-member board, you're going into your Series A and through this difficult period, and the lead VC says, look, we're going to take a chance on you, even though things are very uncertain from a macroeconomic perspective, but we're going to need 2 board seats, and we're going to insist that the 5th is held by an independent that we both agree to. You should not give up control of your board at Series A as a founding team, okay? So there are obviously circumstances where people do, and it probably is the right thing to do. You've got domain expertise or something to that effect that's very attractive and you think can help the business grow. But the board manages and ultimately controls your company. And so unless you are very comfortable with the individuals coming on in that capacity, you should be very wary of relinquishing control at a very early stage. Now, obviously, once you're moving through to your Series B, C, and D and beyond, you do lose control. You do lose balance of power. And that's fine. And that's acceptable. But we're talking early stages here. The other thing is what we call the reserved matters. So in your shareholders agreement, you will agree that a certain list of matters, typically, say 15 to 20 matters, are reserved for the decision of the board and cannot be decided without board approval. And then over and above that, what the lead investor will say is, these are Series A preferred share board approved matters. So in other words, the company cannot take a decision unless the director representing the lead investor signs off on the decision. Easy example might be MAGNiTT is going to take let's say you're post Series A, you are thinking as a founder, guys, I've had a lot of conversations recently with entrepreneurs in Turkey. I know the ecosystem very well there. We're going to go establish a subsidiary in Turkey, and I'm going to hire up a GM there. We're going to start pushing in Turkey. In your shareholders agreement, it might state that the creation of a subsidiary in a foreign jurisdiction outside of the GCC is a board approved matter. So you can't just do that. You need to go back to the board and probably, even if you have 4 out of 5 votes, but you don't have the vote of the director appointed by your lead investor, you can't go and establish that subsidiary in Turkey, right? So you have to be very watchful of what board reserve matters you allow to go into your shareholders agreement. And I think that's a point in time where you be very transparent with your investors, walking them through your business plan, what your strategy is for expansion and growth over the next 18 to 24 months before you raise your next round, having a firm budget in place and getting that signed off at the same time as you close the round. So you can effectively pre-agree certain strategy elements that in your mind you have on the horizon to somewhat defray the risk of a dispute happening at board level over a certain strategy.
And what about information rights? I mean, is that something
big
to be aware of?
Big one right now. I mean, even on convertibles, even when people raising on convertibles right now, I think you're going to see a huge increase in VCs asking for side letters that say you have to provide management accounts within 2 weeks of the end of each month or the end of each quarter, whatever it may be, as a condition of investment. They want to be keeping a very firm eye on your numbers. They want to know who is not meeting the projected KPIs and the like. Now, they want to know it obviously because they want to be as protective as they can of their investments. But for the good actors, of which most are, they also want to ensure that you as a founder aren't being scared to tell them bad news.
Yeah.
And nothing brings the bad news to light like the sunshine, full transparency, what's happening in your numbers. So that's just them helping protect themselves, but I think also knowing that a lot of founders, particularly millennials who have never gone through a recession, are really scared to bring bad news to investors, and they shouldn't be, right? Your investors are there to help. The vast majority are, and they're quite seasoned, a lot of them. They've been through downturns, and obviously they've put their cash into your business. They've sold the idea of your business to their limited partners. Their skin is very much in the game. And I think founders sometimes forget that, right? It's not just your company anymore. You've brought people along for the journey. And there's a lot of expertise within the minds of your investors. And you should make every effort to go and obtain that advice, and be transparent in what's happening, good news or bad news.
I remind anyone, if you have questions, please put them down. We'll get to them in a couple of minutes. I just have two more questions that I'm interested in. Moving on to kind of the bad behavior again. One of the things that many people may be concerned about are investors pulling term sheets that were previously kind of signed or at least agreed. Are there any provisions for founders from that kind of perspective, or well, is there any provisions for that?
You can try in a term sheet to include some type of default penalty. It'd be incredibly difficult. It's completely out of the norm. And I think from the VC's perspective, the kind of counterforce on that is that the ones who know what they're doing, understand that there's a big reputational risk involved in stepping back after you've signed a term sheet, particularly if you said, I'm going to be the lead on this business, provided the terms of the term sheet are reflected in the long form documents, and we can get over any other ancillaries, and in our due diligence, nothing untoward comes out, then we're going to fund. The guys who say, look, this is a really tough environment, we are getting cold feet, the business is still great, we have no problems with it, but we'd like to talk to you in 6 months. Very unprofessional. Unfortunately, we've seen it happen a couple times in recent weeks, but it has not stopped rounds from completing, but it creates hardship and stress for the founder, because then they have to go and discuss with their other investors why investor X is pulling out. So there's a nuance to that, and I think going back to the earlier point, there's a certain level of appreciation from other VCs that because of how extreme this scenario is, a lot of investors are just playing defense and focusing on their existing portfolio and figuring out who's done and who they need to support. But it is very much bad behavior. I'd say you'd have to go to great pains to try to write something into the term sheet that could punish that behavior financially, and probably it would not get through. So again, I would just, as we say, like, diligence is not a one-way exercise. Investors are not simply performing diligence on you. You as a startup should be performing diligence on your investors. Go talk to the founders of their portfolio companies, ask for their contact details, ask very tough questions, get answers out of them. So that is part of the exercise, and hopefully flushes out in advance any negative consequences of bad behavior that could come about as a result of that.
Yeah, I mean, we are in a small ecosystem, and it's very important to be able to leverage the other startups, the other portfolios, the people that you may know of, to get opinions, and opinions matter. On the dry powder, we're trying to do a piece right now and gather information. So if there are any investors on the call that would like to share with us, we're trying to gather all investors that do have actual dry powder to make that clear for people who are looking to raise to be able to support from that exercise. Last question before we go into the Q&A. This could be a whole subject in itself, so I'm not going to go into too much details, but I've been in several conversations at the moment where venture debt keeps coming up as a new option that could help solve startups in the current environment. For anyone that's not familiar with this, what's your view on venture debt, and is it something that is actually applicable right now, and what kind of startups could benefit? I know there's 3 questions there, but just your view on venture debt currently, and whether it's something that is a solution for the current environment.
Just generally, forget the current environment. I think venture debt is an excellent product. I really like it, and we've seen it in action with previous startups that we've advised and supported, and having venture debt included as part of an overall fundraising round. So you might have 70% of the round being raised as equity and 30% being raised as venture debt. And the general parameters of the way that works is you get an investor who says, look, I'm not buying shares right now alongside the other investors. I'm going to give you $3 million as debt, but it's not your traditional loan that a bank would give you with a set payment schedule. You as the startup are going to repay us based on revenues that you bring in. So we're going to take a fixed amount of your revenue, a fixed percentage of your revenue each month until we are repaid. So yes, we will have a long stop date in there, but essentially what the bargain with your venture debt funder is, the better the company does, the more quickly they're repaid. because they're not saying you pay us $1,000 back each month. They're saying you pay us 2.5% of revenue each month. Against, and there's obviously interest there. And then on top of the interest, they will typically also take warrants so that they have the ability to participate in some upside. A warrant is a contract, an option contract that gives them the right to buy shares at a later date at a pre-agreed valuation. So that is typically part of the venture debt mix. No one has done this well yet in the MENA region. There are, in the US, it's a very popular product. In the UK, it's an increasingly popular product. We've been speaking with a number of European venture debt funders, not only in relation to the UK and the European market, but also their potential entry into the MENA region. And it's a blue ocean space. So we've probably talked to people on this call about this, and we don't have time to do it. I would love to, because I think it's a gaping hole in the infrastructure. But again, if you're not making revenue, if your numbers are going down right now, if you are still very early stage, you are probably not a good candidate for venture debt. These are typically post-Series A companies who are showing strong trajectories, strong recurring revenue rates, market standard or below market standard churn rates that the funder has confidence will be able to service the debt quite quickly.
Cool. So we've got quite a few questions. I'm not going to take up a huge amount of your time, but I do want to allocate to trying to get some of these. First question. What options does a startup have if their investors ask to delay or even refuse to pay a tranche that is due?
What does your subscription agreement say? That's the answer. And then ultimately, based on what that agreement says, you will have a governing law dispute resolution clause, and you could sue them. But obviously, you're probably going to need some money to do that. So cajoling, embarrassing, smearing, those are probably your best options that don't cost you money. Using every trick to convince them that it is the right call. But also, going back to my earlier point, and that is bad behavior, they should be quite concerned about their medium to long-term reputational risk in the market, because you will be telling other people that they did that, and rightly so, because those people should be snuffed out.
Awesome. What is the market norm with regards to pay-to-play provisions?
Yeah, great question. Pay-to-play isn't so much a concern for founders or startups. Actually, it's a positive for startups. So the way that a pay-to-play provision would work, and let's use MAGNiTT as an example. Okay, so let's assume MAGNiTT is raising its Series A in a few months, and you've got 500 startups as your lead investor. Let's say, okay, 500's putting in $3 million, but 500 says to the other investors, and I know, guys, that you won't do this, but they say, look, given the uncertainty in the market, if Philip's revenues aren't where we think they need to be in a few months, and this company needs more money, we as 500 know that right now we will put in more money. So even if it's a down round, we will continue to fund. What we don't want to be in a position where none of the other investors that are coming in and buying preferred shares right now all put their hands up and say we're out. So the way that they deal with that is they insist on a pay-to-play provision, which basically says, okay, we're investing now, we're getting our Series A preferred shares, but if the company needs more money in the future and a Series A investor does not participate pro rata, so they don't put in their 5% or whatever they own of the company, then their preferred shares will automatically convert to common shares or ordinary shares. So they lose their preference rights, whatever those preference rights may be, and they now have the same class of shares that the founders have. So it's a way to very much focus the mind of the other investors to say, look, if I'm in this company, I'm in this company, because if we don't follow on, we lose our preference. And that could be a limited time duration thing. It might only last for a set period of time, but that is essentially what a pay-to-play provision is.
Okay, thank you. Here's an operational one. Can you ask Patrick if he sees US overseas investors being happy to invest in ADGM opcos, or will they be required an additional holdco layer elsewhere, Delaware, BVI, etc.?
So we are absolutely seeing overseas investors investing in ADGM holdcos. So if you are running an operating company out of ADGM, you're in WeWork, whatever it is, best practice is to have a dual company structure, because then you essentially can protect the key assets of your business, which are its IP. If you are raising, if you have an ADGM operating company, yes, you could raise money on that. But as an example, if someone sues you in the future for a huge amount of money, all of your assets sit within that entity. So all of your trademarks, all your IP, all your code, they're within that operating company. And the people suing you can go after those assets, which is why all your IP should be held in a separate holding company on top of the operating company. The holding company never enters into a single contract with any third party, right? Yeah. It's just the shareholders agreement, share incentive plan, trademarks, patents, IP, whatever it is. And then it wholly owns the operating company, which deals with the wider world. So, we've set up a whole bunch of structures where it's ADGM SPV, Holdco, ADGM OpCo underneath. We've also done Cayman, Delaware, whatever it is. It depends on your investor, but from the US side, you see an increasing number of US-based VCs who understand that in emerging markets, it's probably not suitable to use Delaware as your holding company for a whole bunch of reasons: filing tax returns, potential knock-on consequences on an exit, where a whole bunch of value can evaporate. And founders don't often realize this. They assume, hey, I can set it up in a day for $500 and that's it. I don't have to worry about it. It's interesting that you haven't seen a regional company exit who's had a Delaware holding company, because I can promise you when that first happens, they're going to be coming and be like, why did no one tell me all of this stuff? Yep. Everyone thinks it's great right now. The real consequences crystallize when there's an exit. And I promise you there will be a big moment of learning when that happens.
We've never done this before, but Tamer from VentureSouk puts his hands up a few times, so I'm going to let him try and speak. I've not tried this before.
Oh, okay.
So, Tamer, over to you.
Yeah, you can hear me?
Yes, sir.
Got you.
Hey, sorry to barge in like this. I wanted to, Pat, you made a point about the tranching, and I wanted to give an example of where that has really burned a company, which I think is helpful. So we've seen many companies that have taken large amounts of funding in a tranched manner or in an option, sort of linked to milestone performance. Yeah. And what happens commonly is that those companies they learn pretty quickly that they're not on a trajectory to meet those milestones to release the second tranche or the third tranche or whatever. In the interim, they need to go to the market to bring in additional capital to hit those milestones. So we don't have enough cash to put fuel in the tank to get us to the revenue number that will release the next tranche. And so they come to us, or they come to someone in the market saying, can you guys come in now that will give us the money that we need, and then that will release another pool of money later. That is a very awkward story for us to look at a company that has the requirement to issue more shares to a previous investor at the same valuation as it was at some previous time. It makes it very, very difficult. Moreover, what we've seen in multiple examples of this is those companies have gone and announced that they have raised a big amount of money. The companies are announcing the capital raise based on the total amount that could be available.
That's on paper, yeah.
On paper, and then they come to us and say, "Hey, we need this bridge," and our immediate reaction is, "What the hell? I thought you just." I mean, I saw on MAGNiTT that you guys raised $1 bazillion. You've already burned through all of, and then it's like, no, actually, we didn't raise that money. We raised only a portion of that, and the other portion, hey, it may or it may not come. And that's happened with companies that we meet with, and sadly to say, it's actually happened with portfolio companies, and it really creates a convoluted story from a fundraising standpoint. So the tranching, yes, it makes it annoying, and now all of a sudden you're managing your business for the milestone, not for the opportunities that are before you. But the other side of it, the other argument is that it really makes things awkward from a fundraising standpoint if you end up taking money in that manner. So that was the point that I wanted to make.
Cool. Thank you very much,
That's a good
Tarek.
point, TQ.
Tamara.
Thank you.
Just a couple of other ones to rattle off. Is a warrant a safe?
No.
Okay.
A warrant, so a safe, you as the startup, you get the cash up front. You sign the agreement, you get the cash. A warrant, you sign the agreement, and at some point in the future, the investor may or may not exercise their warrant rights to purchase shares and then give you cash.
Sorry.
Okay.
TQ7.
Yeah. Somebody was asking a question here that was, I'm not sure. We've raised a seed on a convertible note and had planned to do a Series A late 2020, but we've pushed this back to 2021. What should one be careful of in terms of the new convertible note terms, especially if these may have been offered to existing convertible note investors as well? Not
I'm
sure.
having trouble
Yeah,
following
no,
that one
okay.
as well.
Yeah, okay. Is it typical to set milestones by VCs for ventures? So what if, and could tranches be set in 12 to 18 month milestones?
Tranches could be set in any number of milestones. Obviously, the more lengthy the milestones, dates in particular, the higher the risk to you as a startup. So again, your starting point should be push back against tranches vociferously. If you have no other options, then make the KPIs as flexible as you possibly can, because they might not make sense even in 3 months. That'd be actually impossible to achieve because you've shifted business strategy.
Okay. There's a couple of questions here around like jurisdictions. What if a company is operating in Saudi and foreign investors want to invest? What's the right structure or setup for that? Obviously, it's a more complicated thing, but we're talking about jurisdictional here if we're trying to get investments.
The standard KSA playbook now, as we're seeing across the board, ADGM holding company that owns 100% of the KSA LLC. If there's any non-GCC nationals as shareholders, SAGI approval, or excuse me, I should say what we're now calling it the
investments.
Ministry of
Saudi
Investment.
Arabia.
Exactly. So a MISA approval, which thankfully, due to Dr. Mazen's great efforts, are becoming much more rapidly granted. That will be required as part of the round, but you can't get away from that at this point in time. But because ADGM is recognized as a regional jurisdictioned entity, there are significant advantages that come from that if that is your structure, ADGM, KSA operating company.
I don't want to take too much more of your time, just a couple more. Interesting one. What is the norm in terms of a discount rate for a seed round, and has that changed in the COVID era?
So discount rate, I'm assuming we're talking about convertibles here, whether it's safe for a KISS or a convertible loan. Market norm has become 20% in recent years. I think you're seeing, and we've seen this on a few, people are trying to push that higher, 25, 30%, depending on the business. But there are various levers that you can play with. You as an investor can go for obviously a lower valuation cap, or you can say, look, fine, I'll give you the valuation cap, but I want a higher discount. So that's where you're now seeing a number of notes we've seen, not a majority by any stretch, exceed that 20% standard.
And there's something linked, and he's saying safe or KISS note, can it be done without a valuation cap? Is it common to have a non-cap round being done?
You can do it, absolutely. It is uncommon, and I think that will essentially evaporate now because it's a very company favorable provision to have an uncapped safe where you're just saying, yeah, I'll give you a 20% discount. And you might be thinking, oh, this brand new company, it might be worth $5 million today if they actually did a priced round, but I'm going to invest on an uncapped safe. And then they absolutely hit it out of the park. They're on a roller coaster. They convert 18 months later at a $100 million round. So you bought it at $80 million because you're uncapped. You just get your 20% discount. So yeah, I think that is going to be exceedingly rare to see uncapped convertibles.
A twist on the question that we mentioned, if an investor requires that you move to a country and register your company in that country to be able to get investments, is that a good deal? What do you think?
Depends on the fact pattern, but a lot of people on the chat will know about the ADIO the ADIO Hub 71 program, right? So there's incredible incentives that can be unlocked for regional companies that are able to access those incentives and potential matching funds from the likes of ADIO. However, there are conditions attached to that because they're obviously very actively and strategically building up their ecosystem within Hub 71, and there are requirements to ensure that a good chunk of your tech team is going to remain based there. That is a condition of investment. So, and this all goes to building up that ecosystem rapidly. And you can, when it was open, you could see that policy actually working and taking effect, because now there are actually a lot of people in there right now, some fantastic companies, number of whom we work with, and it's coming to fruition. It is an instrument that typically governments use to drive more rapid adoption and move people into their jurisdiction, to further cement the benefits that brings. It really depends on your fact pattern, right? So if you know, for example, that the company that you are running is very much focused on the GCC or wider MENA region, that is your play. You're not going to go global. And obviously UAE is a fantastic place to launch a startup from, to have your headquarters in. And if in that example you say, yeah, actually I'm very comfortable with this, we're always going to maintain a strong presence here, mind and management are going to continue to be in the UAE, yeah, I'm good with that deal. But like I said, it all comes back to the fact pattern. And as always, as a founder, you have to have your crystal ball out and look forward and say, what could this business look like in a year, in 5 years, in 8 years? And then judge that against the investment proposals that are before you.
I'll do one final question, but one's to me before it goes to you. Can MAGNiTT provide an option for founders to anonymously share their current experience with bad investor behavior? Many are cautious to share more openly how they've been treated out of fear, and that's reflected badly on the startup, also bearing in mind local laws on slander. Let me take that to the team and see what can be done. I mean, it's not the first time somebody's asked us to do this, but it's not also the easiest thing to do and get right. But there's definitely a space there for someone.
I would say, look, beyond that, founders talk to founders, and founders are always generous with their time vis-a-vis other founders. So if you're looking at taking investment from any VC and you can't find a way to talk to someone who has either taken their money or has contemplated taking their money, you're probably not a very good founder, and you should probably just go get a job. Frankly, you don't need MAGNiTT polling for you if you can't accomplish that.
I agree. But what you can do on MAGNiTT is identify the investors on the platform, either connect with them directly or find their portfolio companies and connect and message the founders on MAGNiTT directly as well. A final one, just to wrap it up.
I want to raise, sorry, one quick point to raise, because someone else raised an earlier question. For founders on the call who are struggling with runway and who are now having their investment time horizons pushed back, it goes without saying, you got to be pulling every trick out of the book to extend your runway, whether it's renegotiating your lease or getting banks to waive your fees, whatever it is. But also for your existing team, maybe it's the time to fast forward the discussion around them participating in your share incentive plan and saying, look, if you agreed to a 50% salary reduction for the rest of the year, I'm going to double the options that I was going to give you, as a show of good faith and for you sticking with us through this really tough time. Obviously, that saves you a bunch of cash, further cements the loyalty of your team members. And people have been reducing their personal expenses now anyway. They can't get in a Kareem, they can't go out for dinner, they can't go to the beach on the weekend. Yeah. So you might find that that's an avenue for you to conserve cash.
Final question, completely not related to legal, but somebody asks, and I'm actually interested to wrap this up. What's Patrick's understandably personal view on the outlook for the MENA investment space for the next 12 to 18 months?
Look, I'm in discussions with VCs every single day. We know the ones that have the dry powder that we're working alongside, where we're assisting founders with their fundraising rounds. We're seeing the people, even this month, MAGNiTT announced the I think it was $5.5 million round for 360 views, right? So our team was kind of lead advisor with Khaled and his team on that deal. Great deal. All the investors obviously understood the environment that we're living in. They could have pulled out. They didn't. And there's a lot more investors like that out there that are saying, look, we are investors. We've got cash in a bank account that was given to us by our LPs. We have to spend it within a certain period of time. That's the condition on us. And the world is kind of on sale right now. So I actually think the bright investors are hungry right now, because not only are there good deals out there right now, there's going to be really good deals out there in the months ahead. And particularly as a result of the various injections coming in from the various government programs around the MENA region, a lot of VCs have a lot of cash. So you got to remember, VC is kind of a counter-cyclical thing. This is not the public, it doesn't track the public stock market. There's a lot of venture capital firms that have a lot of cash in bank accounts, and they have a clock on them as to when they have to spend that cash by. And if you're thinking about it properly as a VC, why would you not be trying to deploy when you know that you're basically you're going on the best shopping sale of your life because of the depressed valuations that are going to be here, because of the loyalty that you can instill with the founders for backing them during this super difficult time. I mean, there are going to be VCs that make their name for decades to come right now, if they do it right.
Yep. Cool. Patrick, as always, pleasure. Hoping to have some beers at some point in the next couple of months. We have to wait to see when it happens. I'll ask the team to put out a poll of whether I should shave my head and put the money to charity at some point.
I really hope everyone
and
says
if you want to run a campaign for that, then sure. Thank you very much. I mean, this is a very important subject, because for me it was dear, because I think a lot of people who may be desperate to take cash will skim through this, will cut on legal costs, will not necessarily take the necessary procedures because they're desperate for the cash. But decisions you make now may lead to challenges in the future. So I think it was just important to highlight where we can, repeating what I said, and you don't need a lawyer to tell you that you need to get legal counsel, and each case is individual. But thank you very much for sharing your time, your insights, and I hope to catch up soon.
Absolutely. Thanks, everyone. Thanks.
Thank you very much. Take care.